Welcome back. This is Trey Salverson, your favorite Bitcoiner, and this is the biggest story in finance, and almost nobody is talking about it. Japanese bond yields are skyrocketing, US Treasury yields keep rising, gold is making new all-time highs nearly every day. This isn't normal market behavior. This is a confidence breakdown in sovereign debt playing out in real time. And Bitcoin's institutional adoption is the direct response. The sovereign debt crisis. Let me show you what's really happening. For decades, the game was simple. Governments borrow money, central banks print to cover it, and repeat. The assumption was that you could always print your way out of crisis. That experiment is over. When your debt to GDP gets too high and your country cannot produce enough to sustain the debt, you're left with two options. Option 1, print money to pay the interest. Option 2, let everything break. Both options destroy confidence, and right now the market knows it. Nobody is buying treasuries anymore. Not at the old prices, not with the same confidence. And this is because everyone can see where the ship is heading. Central banks are voting with their wallets. They're putting their money where their mouth is. Here's what should get your attention. Central banks that have been reliable treasury buyers for decades are now net sellers. And what are they buying instead? Gold. Massive amounts of gold. This isn't portfolio rebalancing. This is a vote of no confidence. When the very institutions that prop up the current system start looking for exits, that should tell you something. Rising gold prices aren't just about inflation anymore. They're about sovereign entities preparing for a world where paper promises, all of them, become questionable. Gold has been humanity's monetary fallback for thousands of years, but it has fundamental problems. Gold is a heavy rock that's hard to securely store. It's hard to divide for transactions. It's hard to verify authenticity. It's nearly impossible to transport and transfer globally, and more gold is mined every single year. These aren't minor inconveniences. These are fatal flaws for a global digital economy. Bitcoin solves every single one of these problems. Bitcoin is trivially divisible down to 100 millionth of a coin. It's instantly verifiable by anyone running the software. It transfers globally in minutes. It's secured by cryptography, not vaults. And most importantly, there will only ever be 21 million Bitcoin. No central bank can print more. No government can change the supply schedule. It's enforced by mathematics and code. It's getting harder and harder to mine Bitcoin. And when the 21 millionth Bitcoin is distributed in the year 2140, that's it. 21 million Bitcoin will then be constantly traded between buyers and sellers forever. The real opportunity. Here's where most people get the Bitcoin thesis completely wrong. They think Bitcoin is competing with gold's roughly $30 trillion market cap. Bitcoin isn't competing with gold. Bitcoin is competing with the entire global bond market. The global bond market is over $130 trillion. Bitcoin's current market cap is around 1.8 trillion. Think about what that means. Treasuries, sovereign bonds, corporate debt, all of it represents someone's promise to pay you back in currency that's being actively debased. Bitcoin is the only major asset with zero counterparty risk, a supply schedule that cannot be manipulated, global accessibility 24/7, 365, and mathematical scarcity. If institutions, pension funds, and sovereign wealth funds start allocating even 1 to 5% of their fixed income holdings into Bitcoin as the actual risk-free asset, we're talking about capital flows that would dwarf the entire current crypto market cap many times over. This isn't speculation, this is basic portfolio allocation math in a world where confidence in sovereign debt is breaking down. The infrastructure is already built. And here's the critical part. This isn't some theoretical future. The rails for institutional adoption are already operational. Spot Bitcoin ETFs are approved and trading billions of dollars daily. Major custodians like Fidelity and BlackRock are offering Bitcoin services. IBIT, BlackRock's Bitcoin ETF, is the fastest growing and best performing ETF that's ever been released into the financial markets. There has never been another instrument to get to $100 billion market cap quicker than the IBIT BlackRock Bitcoin ETF. The Lightning Network enables high-frequency, low-cost transactions at scale. So all the other cryptos you hear about offering faster transactions, cheaper transactions, those arguments are all null and void. They don't even matter. The Lightning Network lets you do everything in Bitcoin always. Regulated exchanges and custody solutions exist for institutions. Bitcoin is already on corporate balance sheets. Strategy, formerly known as MicroStrategy, now owns over 700,000 Bitcoin, valued at roughly $70 billion. Tesla owns Bitcoin, and 194 other public companies own Bitcoin around the world. And here's the real game changer. Fixed income products like STRC and SATA are now yielding 11 to 12% annually. That's nearly 3 times the return of traditional high-yield savings accounts and money market funds. The so-called safe options that guarantee you lose purchasing power every single year. The bridge between traditional finance and Bitcoin isn't being built, it's already operational. The capital and money is already flowing into Bitcoin. Why rising yields are bullish for Bitcoin. Here's what you need to understand. Rising treasury yields and rising gold prices are happening at the same time. In the old playbook, that wasn't supposed to happen. Rising yields meant money flowed out of gold and into safe government bonds. That's not happening anymore. The market is screaming that there is no safe haven in paper assets. Yes, rising yields might hurt Bitcoin's price in the short term as capital temporarily chases higher nominal returns, but it's proving the thesis. The world has lost faith in the sovereign debt system, and when that realization fully sets in, where does that capital go? Not to bonds that yield 5% while being debased at 7%, not to stocks that are claims on fiat earnings in a dying currency system, not to gold that can't function in a digital economy. It goes to the hardest, most scarce, most transportable, most verifiable money that has ever existed, Bitcoin. Bitcoin's institutional adoption is not a side story. It's not crypto hype, Moon Bros, Lambo Bros. It's not retail speculation. It's the rational response to a global financial system that's running out of road. The infrastructure is built. The capital is ready. The confidence in the old system is breaking down in real time. The question isn't if institutional capital flows into Bitcoin. The question is how fast.